Hello and welcome to the You're an Asset podcast. I'm your host, Casey the Dollar. And on this podcast, we find out who is an asset in the financial industry and who is just an ass. Thanks so much for joining me, everyone. We are back with an episode with a hot topic. Today, we're going to be talking about the cost of insurance. And we're going to go over 3 different policies and each of their individual costs of insurance. We're going to look at the same person, same age, same health rating, same return inside the policy, and really break down the differences between them, long-term, short-term, everything in between. We're going to be looking at 3 different carriers, 3 separate products, all A-rated companies, using a 6.3% average return. It's going to be a 40-year-old male in standard health, contributing $1,000 a month into a max funded minimum death benefit policy with an option B death benefit, meaning we get to start with that actual minimum and increase the amount of death benefit along the way. Now, each different carrier labels the different fees and costs differently. We have the premium load, which could also be the premium charge or the premium expense. Ultimately, what the premium load is a percentage of the annual premium going into the policy every year. We also have the cost of insurance. Of course, it's based on your age, your gender, your health, and the total amount of death benefit that you purchased. So that's 2 different charges within an IUL. We also have what are called additional expenses, additional charges, admin fees, which is your 3rd charge. These fees are associated with maintaining the policy, the customer service that the carrier offers, the back office tools that are available to you, and ultimately just managing your policy, admin fees or additional expenses. We also will see charges called policy fees, policy charges. These are all different charges for issuing the policy, providing you with the policy each year. There could also be charges for any additional riders. Sometimes riders make the policy more expensive. Sometimes riders make the policy less expensive, meaning that ultimately some policies can be made less expensive than others. If they offer this term rider, you're going to see this rider charge listed on your policy. So let's break down policy 1, policy 2, and policy 3. Before we move forward, I want to mention the death benefit amounts that are associated with each policy as well. The death benefit on policy 1 is $200,000. The death benefit on policy 2 is $200,000. And the death benefit on policy 3 is $227,000. We're putting the same amount of money, and the client is exactly the same. I'm not going to get into exactly what each charge for each policy individually is, but I am going to give you the cost of insurance on year 1 all the way up to year 50, when this person would be 90 years old, so that we can see throughout the life of the policy how the cost of insurance changes. I'm also going to mention that policy number 2 and 3 have a term supplement rider added onto them, meaning that their cost of insurance has been lowered by the ability to add this rider. Policy 1 does not have a term supplement rider, but policy 1 offers the most living benefits, which, if you're familiar, living benefits are an added critical, chronic, and terminal illness rider, which would accelerate a portion of the death benefit to the insured person if they were to become ill. Policy 2 and 3 don't have as great of living benefits and only offer the chronic and terminal illness riders, leaving off the critical illness rider. So let's get into it. Policy 1, year 1, the client is 40 years old. The total contribution is $12,000. The cost of insurance is $1,664 for the year. Policy 2, cost of insurance, $2,026. Policy 3, cost of insurance, $1,241. Big difference there between the three. We have policy 2 being the most expensive, which has a term rider in it. Policy 1 with the most living benefits came in at the second most expensive, and policy 3 that also had a term rider was the least expensive. I also want to mention what the cash value was on each of these policies after year 1. Policy number 1 had a cash value of $4,836. Policy 2 had a cash value of $6,452. And policy 3 had a cash value of $7,326. Now remember, policy 2 was the most expensive, but it actually has the second highest cash value. The cash value that I'm talking about is not the overall value of the policy. Those amounts are actually higher. I'm talking about the actual liquid cash value that's available to borrow after the first year. Year 5. The total contribution is $60,000. The person is 45 years old. Policy 1 had an annual cost of insurance of $1,965. Policy 2 had a total cost of insurance of $1,611. And policy 3 had a total cost of insurance of $1,336. Policy 3 is still the least expensive, but now policy 1 is the most expensive. Jumping to year 10, the client is now 50 years old. The total contribution is $120,000. Policy number 1 had an annual cost of insurance of $2,276. Policy 2 had an annual cost of insurance of $1,689. And policy 3 had an annual cost of insurance of $1,524. Policy number 1, still the most expensive. Let's check out the cash values of the 3 different policies. Remember, $120,000 has been contributed. Policy 1 has a cash value, accessible liquid cash value of $132,811. Policy number 2 has a cash value of $143,726. And policy number 3 has a cash value of $141,405. Policy number 2 now has the most cash value of all 3 policies. Policy number 1 has the least cash value, which does make sense because its cost of insurance has been the highest. But again, it also has the most thorough living benefits compared to the other 2. Year 15. Policy 1, total cost of insurance for the year, $2,575. Policy 2, cost of insurance, $1,900. Policy 3, $1,347. Now, something important happened here. The client is 55 years old. They've had this policy for 15 years. And policy 3, we actually saw a drop in the cost of insurance. It went down a little less than $200 for the year on year 15. Just an important note that I think is worth mentioning. But let's jump to year 26. Year 26 is important because the client's going to fund their policy for 25 years. So on year 26, no more premium is going to go into the policy. And what happens to the cost of insurance when no more premium is being contributed? The premium load charge actually falls off. It goes away. The client would now be 66 years old, and they've contributed a total of $300,000. Policy 1. The total cost of insurance for the year was $3,303. Policy two, the total cost of insurance for the year, $784. And policy three, the cost of insurance for the year was $2,254. Wow. Major change in the cost of insurance here. We still see that policy one is the most expensive and it's continually gone up over time. Policy number two drastically dropped the cost of insurance. We're talking more than half of what it was 10 years ago, from 1900 to 784 by retirement age. And at age 66, this is a very important time in a person's life that they actually really need coverage. So the fact that the cost of insurance is so low is incredible. Policy number three has also gone up over time, but it's still been much less than policy one. Let's check out the cash values at this point in time. Remember that the total contribution for each policy is $300,000. Policy one has a cash value of $561,310. Policy number two, the cash value is $631,364. And policy number three has a cash value of $620,173. Policy two and three are very close. Policy number one is quite far behind. There's a $70,000 difference between policy one and policy two. And that has a lot to do with the cost of insurance. But policy number one, just to reiterate again, does offer more within the policy, and that makes it more expensive. That doesn't have to be seen as a bad thing, a good thing. It's really up to each person. And when you're deciding on which policy, you're going to think about what all you're getting inside the policy, not just the cash value. So I think it's important to remember that some policies are offering more than others, and that is ultimately going to affect the cost. But again, the cost of insurance is also really important when our focus is cash value, right? We want to build as much cash value as possible to be able to have the highest income coming out of the policy. So to each their own. Let's look at year 40. Year 40, the client is now 80 years old. The total cost of insurance on year 40 for policy one is $4,681. Policy two, total cost of insurance, $1,233. And policy number three, $2,936. Policy three has been very consistent. Policy two went up a little bit, of course, from the last time we looked at the cost of insurance. And policy number one keeps getting more expensive. And finally, let's look at year 50 when the client is 90 years old. Total contribution was still $300,000. And I'll warn you, this year for one of these policies is going to be a bit extreme. Policy number one, total cost of insurance for the year was $20,978. Policy number two, $4,821. And policy number three, the total cost of insurance for the year was $13,275. Policy three came out of nowhere with this last year of cost of insurance. It shot up $11,000 since we looked at it 10 years ago. Same thing with policy number one. It went up over $16,000 since the last time we looked at it. Policy two only went up around $3,000. Now, life insurance companies, they know that at this time in a person's life, they're most likely going to have to pay out that death benefit pretty soon. When someone's 90, it could be any day, right? A lot of us are really lucky to live till the age of 90. And so it makes sense that we see such a higher cost of insurance within these policies. And I will say that obviously knowing this kind of information would sway you to want one policy over the other. If you're paying for a policy because you want cash value, then it makes sense to go with the policy that has the lowest cost of insurance. But again, Some people are going to see what a life insurance policy has to offer, like the extra living benefits, and be willing to pay more for the policy. I would say the most important thing is that the person you're working with is actually going over these numbers with you so that you know what you're getting into and where your money's going and what the cost is. I do want to talk about the cash value of each of these policies at age 90 and let you know that in these projections, I have also shown $50,000 per year coming out in the form of a loan from age 66 all the way through age 120. Each policy was able to distribute $50,000 a year for the client as income in the form of a tax-free loan. So when we think about that, it's quite interesting that they all had such different costs of insurance, such different cash values, but the same contribution ultimately led to the same amount of income. Now, is it possible that one of them would outperform the other in real time? Of course. I showed the interest earned the same across the board to be as fair as possible to all of the policies for this example. But we don't know what's going to happen in real time. So the cost of insurance is a really big deal, something that you want to take into account. But let's talk about the cash value when this person is 90 years old. Policy 1, the cash value at 90 years old, after taking $50,000 per year starting at age 66, is $494,757. Policy number 2 has a cash value of $258,938. And policy number 3 has a cash value of $373,045. Do you see what just happened there? If you didn't catch it, policy number 1, which has been the most expensive throughout the life of the policy, spit out the same amount of income for the client each year, along with the other two, actually has the most amount of money still in the policy. Weird, right? I don't have a perfect reason for why that is, because, side note, extra fun facts for all of you, there's something called positive arbitrage, and all 3 carriers, it's industry standard that we can only show a positive arbitrage of 0.5%, meaning that there really is a level playing field here. Now, some carriers have bonuses worked into their illustration, some don't, but even with, say, a 1% bonus added to the total return of the policy, you just heard that the cost of insurance on policy number 1 was way more expensive, yet somehow it spit out the same amount of money and ended up with a higher cash value at the end. This just goes to show that there are so many different variables playing inside a cash value life insurance policy. And I can think of one that I'll let you guys in on. One is how they credit the policy, how they credit the overall account value. Some carriers credit the account value after only subtracting the premium load charge, which, if you remember, is about 5% across the board. And then the remaining amount of money gets credited interest. Other carriers take the premium load charge and the cost of insurance and the additional fees and the policy charges, the extra policy charges, away from the total amount of money contributed or the account value, and then credit the value of the policy. Just that different sequence of events can lead to much different results within an IUL. So there are factors at play here that we can't see. Some people on the internet like to claim that 40% of your premium is going to the cost of insurance. And that is clearly not the case, you guys, as you can see. Yes, there are some years where the cost of insurance is about 15% of the premium, but there are some years where it's much less than that. So don't believe everything you see on the internet. The cost of insurance can be minimized in so many ways. And again, that's why you work with an agent who knows what they're talking about and how to set up these policies correctly so that you are the one that has the advantage and gets the most benefit out of the policy. Now, your friends at Power 3 Financial know all about these secrets and teach about them on the podcast with our clients one-on-one. so that you really understand what you're looking at. Because we believe that it's really important for you to have full transparency when you're purchasing a policy like this. You can tell that there is a large cost, even if it is only $4,000 a year, $1,000 a year. You need to know that information. I really hope that this was helpful. I hope that it was insightful. I hope you got a lot out of it. If you had a hard time following along, if you're just listening on Spotify or on Apple Music, make sure you go to our YouTube channel and watch the full video where you can see the numbers right in front of your face and really follow along. So it makes more sense. We would love it if you checked us out on YouTube, on the You're an Asset podcast. Subscribe so you don't miss another episode. Everything you need to get in touch with us is in the description below. This has been the You're an Asset podcast. Thanks so much for listening. I'll see you guys next week. Bye. The You're an Asset podcast is not giving financial advice. We are not licensed financial advisors, and our licensing is strictly in insurance products. The information that we talk about is specific to the products that we work with. We cannot guarantee that other agents will have the same product features that we discuss on the show.